My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. Other people make friends. I'm just trying to make you some money. My job is not just to entertain, but to educate, teach. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. This market's become a proverbial game of chicken. Who can buy the most of what's working at this very moment before a recession takes it all away? That's how we rallied so hard earlier this week, even if the averages cooled on Tuesday when some Fed officials scared us. Today was sedate on the surface, Dow dipping 86 points, S&P declining 0.08%, NASDAQ advancing 0.41%. But there's a lot going on underneath we got to talk about. Why is it like this? Because for the most part, things are going very well in the country, right at this moment, even if we're worried that the Fed will ultimately crush the economy. We always hear that it's the Fed's job to take away the punch bowl when things get out of hand. And I think that's a pretty good analogy, but I want to take it further. Right now, there are tons of places where things aren't out of hand. They're just very good. They aren't at the root of inflation. They can stand up under close Fed scrutiny. The Fed will let these industries get buzzed. We like that. They just don't want anyone getting hammered. Let me give you some classic examples, starting with housing. Home prices were soaring in this country, up 20% year over year, and in some regions 30 or even 40%. The housing market was wasted, drunk as a skunk. So naturally, mortgage rates shot up, as they should when the Fed raises rates and things get too hot, and then the buyers disappeared. Out of nowhere, the housing stocks just got annihilated. But then rates suddenly plummeted much faster than anyone expected, and slowly but surely, the housing market has started to sober up. Now it's just buzzed. Mortgage rates have come down a bit, and the housing stocks have quietly made a little comeback. As long as housing prices don't start skyrocketing again, you can get away with buying the home builders here. Home builders like Toll Brothers or Lennar, just as long as you don't let them drive. Each industry is facing the same dilemma. Oil is rolling higher for months, sending the oil stocks higher, 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 but crushing the consumer. Yep, the oil investors went from buzz to hammer. Then the Fed raised rates aggressively. We saw endless stories about the price at the pump, and then crude came right back down, but to little or no fanfare. What matters now is that oil's down big, gasoline's down big, and you can now buy all sorts of stocks that benefit from cheaper fuel, especially the travel and leisure plays that were so scorned just 3 weeks ago. What was most trashed when oil was flying? I don't know. I think Disney. People extrapolated that theme parks would be crushed by higher gasoline. Now, Disney can probably run from 108 where it went out today, I think, to 120 without getting hammered. Why not? It was at 180 when gas prices were tame. Or you can get into the real Fed woods. Yesterday, AMD reported, and it was an amazing quarter, just terrific. But there were an armful of Fed officials at the same time who came out and made you feel like a total dope if you bought anything. So the stock belly flopped. Forget the buzzed hammered analogy for a moment. Today, no Fed speak. So what happens? AMD, same AMD as yesterday, sans, I've always wanted to use that term, sans my interview with CEO Lisa Su last night, and the stock just explodes higher. Total liftoff, up nearly 6%. Same AMD. I think yesterday was the aberration. Today's move made a ton of sense. One more. When we're going into a recession, you're supposed to sell the industrials, right? We know that. They're way too dangerous in a slowdown. But if oil's down in price, and grains are down in price, and metals are down in price, and plastic is down in price, and paperboard is down in price, how can you not circle back to some of the cyclicals that reported terrific numbers? There were no flies on Waste Management when we spoke to them when it was barely up just last week, so why not go to town with them? 3M is a cyclical that's been kept down by Fed chatter. Buy that with the added kicker of the food safety split-off today. Or how about my favorite, Honeywell? Picture-perfect quarter, raising of the organic growth rate, but it had the disadvantage of reporting on a day of such horrendous Fed speak that people ran from it. I say go for the Honeywell buzz now, especially because their aerospace business is doing better since gasoline's lower. Let me give you another one with real buzz. Ford. Tremendous quarter. Huge dividend boost, making the stock very attractive versus bonds with 4% yield. Tremendous order book, Big beneficiary of lower raw costs like aluminum and steel, and lower rates means it's cheaper to get financing. Out of nowhere, a stock that was sold 9 ways to Sunday when commodity prices were going up, the Fed wouldn't stop talking, and a recession was about to scuttle a whole industry, is now a screaming buy. I say go for the buzz of Ford at 15, perhaps to as high as $18, but do not, I repeat, do not get hammered at 20. Sell, sell, sell. While we're at it, throw in DoorDash and Expedia. DoorDash has worked hard to get their earnings before interest, taxes, depreciation, and amortization into positive territory, which is why the stock soared in after-hours trading when it reported a really nice number. Expedia showed that people are still traveling, so with gas prices down, why not buy that one? These companies are buzzed and not hammered. What's driving all of this craziness? All right. I think the Fed officials who warned that we need endless rate hikes, I think they're the ones who are behind the curve. They've won the war against commodity inflation, but they don't know how to take yes for an answer. Sure, maybe commodities won't stay down, and I'm certainly not saying that the Fed's work is done. That would be wrong. But, man, they've made real progress, and they keep ignoring their own progress. We're now enjoying one of the most monumental commodity collapses I have ever seen in 40 years of trading. Yet nobody talks about it at the Fed because it doesn't fit their preferred narrative of runaway pricing. What's our real takeaway? Pretty simple. I think there's a Fed media short seller nexus that makes us feel like any positive news on the inflation front is just meaningless, must be ignored, certainly not rigorous. We're supposed to ignore the in-your-face positives like cheaper gasoline, declining grain, plastic, wood, and instead focus on how everybody's doing too well? What does the Fed really want us to do? What do they want from us? Do they want every company to miss earnings and lay people off? Do they want the stock market cratered? Should we hide in our homes like we did during the worst phases of COVID? What makes all this so confusing is that this market's still very much in bad is good mode. If we get a strong employment number tomorrow at 8:30, it's awful because it means the economy's getting hammered and the Fed needs to take away the punch bowl. On top of that, the Fed's failure to acknowledge anything that's going their way has hurt their credibility. Finally, the real source of the hammer? Our elected leaders in Congress and the White House. They're refilling the punch bowl right when the Fed wants it removed. And I am not a political guy. Congress just passed the CHIPS and Science Act, which is supposed to cost $52 billion for the chips. We desperately need that money to rebuild domestic semiconductor manufacturing. But how about the other $228 billion they gave for the science? Well, some of that's legitimate science spending. The truth is we don't have the labor force to support the whole package. And it could cause serious wage inflation, exactly the thing that the Fed is simultaneously trying to stamp out. Listen, I'm not some deficit hawk and I'm not some politician. When we had 10% unemployment, I came out here every night demanding more stimulus spending. But now we have 3.6 unemployment. The economy's overheated. And big government spending just means the Fed will have to raise interest rates even more aggressively, hurting the working person that they keep saying they're going to help. Congress is trying to get us hammered right at the moment when we only can afford to get buzz. The more they spend, the more often you'll hear these Fed heads warn that they need to take interest rates to 4 or even higher. So the bottom line, frolic while you can. But remember, these Fed gas bags won't shut up, and Congress can't stop spending. They're the ones behind the bear market of 2022, not the companies, and certainly not you. Alan in Pennsylvania. Alan.
Hey, Tim. Alan from Springfield, Delco. Good to talk with you again.
I'm Monco, but I'll listen to you anyway. What's going on?
There you go. I need your help. I'm down about 20% or over 20% on tech stocks this year, and I wanted to check if you'd be a buyer of AMAT or Marvel, another one of your favorites.
Yes, I would be. I just said at our meeting today. That's our club meeting that was held at 12 o'clock. That Marvell Technology, Jeff Marks and I agreed that that's a terrific one to buy. Surprised it wasn't up given the strength in AMD. Can we go to Tad in North Carolina, please, Tad?
Hi, Jim. This is Tad in Statesville, North Carolina, sending you a big Tar Heel booyah.
I always tell my wife it's called Fayetteville. She never stops with the Fayetteville. I'm going to make she knows I have a show now, so I may tell her to watch it.
It is Statesville. Anyway, appreciate all you do. Really, your advice has been a huge help in my investing life.
Thank you, Ted.
That's so much. This morning, Datadog released another great earnings report, which they typically do, but their guidance was a little light going in the second half of the year. No, they typically guide conservatively. But I wanted to get your thoughts on that company in this beat-down sector.
Okay, well, I think, first of all, I think it is a very crowded sector in the market. But second, let's remember, Tad, that stock opened down very badly, and then climbed its way almost all the way back because, as you said, it was a good quarter. But there are too many companies in that sector for me to get excited about. Now we're going to go to Thomas in New York. Thomas.
Hi, Jim. How are you? A long-time listener. I love your show. It's a great show.
Thomas, thank you so much. Thank you. I hope you like it downtown. I think it's pretty cool that we're down here.
Oh, great. That's nice to hear. Beautiful.
Thank you.
I'm going to ask you about SoFi Tech. I have a ton of my shares of SoFi, and yesterday with the 26% increase, I'm wondering if it's time to get out or if I should still stay
No. I
in.
went over the quarter with Anthony Noto, whom I've known faithfully since 1998. This was a very good quarter. A lot of things he promised have now been delivered, and I think it's a mistake to sell SoFi right here. Noto's done a good job. He really has turned the company around, and if anything, I'd be a buyer, not a seller of SoFi, even after this move. Remember, the Fed and Congress are behind the bear market of 2022, not the companies, and certainly not you. On Mad Money tonight, Chemours, yes, CC, has clawed back from its recent lows. So is now a good time to take a look at the chemical company stock, or have you missed the move? I'm talking to the CEO. Then XPO Logistics continues its spin-off plans. And after announcing a new CEO tonight after the bell, I'm learning more about the company's plans for the future with the incoming and outgoing CEOs. And Federal Realty, long a fave, announced earnings this morning along with its 55th dividend increase. So could this REIT continue to deliver for shareholders? I'm checking in with the company's top brass. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.